Introduction to Capital Budgeting. Capital budgeting, also known as investment appraisal, is the process by which businesses evaluate and select long-term investments that are in line with their strategic goals. These investments often include purchasing new machinery, launching new products, expanding operations, or acquiring other companies. Because these decisions involve significant capital and long-term impact, they require detailed analysis using financial, strategic, and risk-based criteria. At its core, capital budgeting answers the question, what? Is this investment project worth the money? Importance of capital budgeting. Capital budgeting is one of the most critical financial functions for the following reasons. Strategic direction, determines how and where capital is allocated. Profitability, ensures only viable and profitable projects are undertaken. Cash flow management involves forecasting inflows, outflows to avoid liquidity crises. Shareholder value, 0.000. Helps increase shareholder wealth by choosing high return projects. Risk mitigation, avoids poor decisions that could lead to bankruptcy or loss of market share. Key features of capital budgeting decisions. Long-term orientation. Focus on decisions that will affect the business for years. High initial costs. Often require large capital outlay. Irreversibility. Once committed, it may be hard to reverse the decision without losses, risk, and uncertainty. Outcomes depend on future market conditions and assumptions. Impact on profitability. Directly affects the business's ability to generate returns. Types of capital investment projects. Expansion projects. Increase production capacity or service delivery. Replacement projects. Replace outdated or inefficient equipment. Research and development, R&D. Investment in innovation for future competitiveness. Regulatory projects. Mandated by law, e.g., environmental upgrades. Strategic projects, entering new markets, vertical integration, etc. Capital budgeting techniques. There are several well-established methods to evaluate the desirability and feasibility of capital investments. 1. Payback period, PBP, measures the time required to recover the initial investment. Formula, point. Payback period equals initial investment divided by annual cash inflow. Example. Investment, 1 million naira, annual inflow, 250,000 naira, PBP, 1 million naira divided by 250,000 naira equals 4 years advantages. Simple and easy to understand, useful for liquidity analysis. Disadvantages. Ignores time value of money, TVM. Ignores cash flows after payback period, 2. Net present value, NPV. Calculates the present value of all future cash inflows minus the initial investment. Formula, point. NPV equals the sum of cash inflow divided by 1 plus R to the power of T minus initial investment, where IR equals discount rate, T equals time period. Example, investment equals 1 million naira, yearly inflow equals 300,000 naira for 5 years, discount rate equals 10%, NPV equals 137,000 naira. Positive, so the project is acceptable. Advantages. Considers TVM. Considers all cash flows, indicates value addition. Disadvantages. Complex to calculate, assumes a constant discount rate 3.0. Internal rate of return, IRR. The discount rate that makes NPV equals 0. Decision rule. Accept project if IRR greater than cost of capital. Example, If IRR equals 14% and cost of capital equals 10%, accept the project. Advantages. Considers TVM easier to compare across projects. Disadvantages. May give multiple rates with non-conventional cash flows, not suitable for mutually exclusive projects. 4. Profitability Index, PI. ratio of the present value of future cash inflows to the initial investment. Formula: point PI equals PV of future cash inflows divided by initial investment example : PV of inflows equals 1,200,000 naira. Initial investment equals 1 million naira. PI equals 1.2 greater than 1, so acceptable advantages. Useful when capital is rationed. Considers TVM disadvantages. Can be misleading for large projects. 5 accounting rate of return, ARR. Measures the average annual accounting profit against the initial investment. Formula: point ARR equals average annual profit divided by initial investment. Advantages: simple and uses accounting data. Disadvantages: ignores TVM, focuses on profit, not cash flows. Time value of money in capital budgeting. TVM is a crucial principle in capital budgeting. It ensures that future cash flows are appropriately discounted to reflect their true worth today. For example, receiving 500,000 naira in 3 years is not the same as receiving 500,000 naira today. Discounting ensures accurate comparisons between projects. Risk analysis in investment appraisal. Capital projects are exposed to various types of risks: market risk, changes in customer demand, competition, operational risk, failure in processes or equipment, financial risk, interest rate hikes, inflation, political risk, regulatory changes, tax reforms, techniques to analyze, risk, sensitivity analysis, changes one variable at a time, e.g., sales volume, scenario analysis, examines different outcomes, worst case, base case, best case. Simulation uses software to model probabilities. Strategic and ethical considerations. Capital budgeting should not be purely mathematical. Strategic alignment and ethical implications must be considered. Does the investment align with the company's mission? Will it cause environmental harm or social backlash? Is it legal and compliant? Example: a factory relocation might be profitable but could displace local communities or violate labor laws. Real-life application example scenario. A Nigerian beverage company considers installing solar panels to reduce energy costs. Initial cost: 0.000. 15 million naira. Expected savings: 3 million naira per year for 7 years. Discount rate: 12% NPV. Positive payback period: 5 years. IRR: 16% decision. Project accepted. Though upfront cost is high, it ensures long-term sustainability and operational savings. Summary and conclusion. Capital budgeting is more than a financial process. It is a strategic decision-making tool that determines the future direction and profitability of a business. Using techniques such as NPV, IRR, and payback period, financial managers can evaluate projects rigorously and decide how best to allocate scarce resources. Effective investment appraisal is key to sustainable growth, risk management, and maximizing shareholder value. Businesses that master capital budgeting are more likely to make bold but sound financial decisions in dynamic economic environments.